When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current event headlines, also holiday market fears, misconceptions, and smart planning. We'll answer listener questions, and then finally protecting a spouse, the most overlooked risk in retirement planning. My name is Jeff Shade. I'm just here to ask the questions, but of course, the words of wisdom and solid advice, they come from the other Jeff on this radio show. It's Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
Doing great. How are you doing?
I'm doing fantastic. Had a great holiday weekend with Thanksgiving, and we're launching headlong into the Christmas season. And before you know it, 2026, less than 30 days away. So let's break down the latest economic headlines, Jeff, rate cut expectations, global bond shocks, and what all this means for investors and retirees. Let's start with a big headline, though, Jeff. A lot of investors are betting that the Fed will cut interest rates by a quarter point on December the 10th. Markets liked that news at first. We also saw some turbulence in the first few days of December. Why do you think that is? What's going on here?
Well, I'm not really sure what's going to happen. I think there's a lot of, I don't know, everybody just tries to make bets on the market. We've seen increased volatility. We've seen the swings up and the swings down kind of exacerbated over the last few weeks, especially. And a lot of it, I think, is banking on this, whatever the Fed does, rate decreases, rate increases. Just earlier this week, bonds sold off, basically making the interest rates go up, not down. So again, last couple of times that the Fed has lowered interest rates, we've seen the bond market sell off. And I think the lowered interest rates is partly because I think the bond holders think, oh, well, the lowered interest rates can make the stock market go good. So they sell their bonds in order to get back into the market and buy tech stocks and things like that. And I think that's really kind of the play for most of the non-informed investors rather than the super big hedge funds and the super big money managers like Warren Buffett, who's got over $1 trillion under management. Ray Dalio, the biggest hedge fund manager, I don't remember how many billions he has, but he's a pretty famous hedge fund guy and has consistently beat the market. And he's not actively managing it now, but he's kind of handed off the baton to some assistants that have been around for a long time. But they're selling a lot of tech stocks. They're divesting in a big way, especially the Mag 7 and some of those that have carried the market. They're reducing their shares. We see Kathy Wood, who does ARK Investments. She's kind of that innovator investment guru, supposedly, that has probably lost more money in the last 5 years than she's made. But she's got some wild riding tech stocks, and all of hers are losing value and selling off. So the things that have made a lot of money in the past, including AI stocks and a lot of the tech stuff, even though some individual stocks are on a run, it seems like overall they look like they're weakening up a bit. But then again, you look at the Qs, the QQQ, which is typically mirrors the NASDAQ or mostly the tech stocks. We're still seeing the QQQs manage to look somewhat strong, not super weak, but those individual stocks that have driven the Qs in the past look like they're weakening, and they eventually will drag the market down, I think. So just because the Fed lowers interest rates, 0.5%, but if the bonds sell off and interest rates actually go up in real life, I got a special advertisement in the mail the other day that I could trade my car in and get a new car. And they give me this special financing deal because of my great credit at 8.9%, which was like ridiculous. I'm thinking, interest rates aren't going down. They keep talking about it, but in real life, we're paying more to borrow money for cars. We're paying more to borrow money for houses. We haven't seen mortgage rates fall any significant amount in the last year or so, or even over the last 2 or 3 rate cuts. So even though they say they're going to cut rates, I don't think it's going to have any material effect on the market. The market's going to do what the market does. The market's going to do whatever it does based on how much smart money is selling and how fast they do it. And right now I've seen it over the last year be more methodical. In other words, no big fund manager, no pension fund guy, no Warren Buffett, no Berkshire Hathaway or Dalio or any of these big fund managers, that they don't want to sell big lots of stock at once, so they will crash the market. In fact, the market even has stops in place to where you can't overload the market with sells. And so they try to balance the market out. Fortunately for them, there is so many people, I think it's pushing close to 70% of households are stock owners now, which is not typically the norm. Normally, less than 50% of American households own stock. And when more than that do, that means more uninformed investor, we'll call it the dumb money instead of smart money. Even though smart money is not always smart, they don't always make money, even though dumb money can be super smart and make tons of money, but most don't because of the lack of information, lack of timing, lack of ability to make the market. They basically have to time the market, follow the market, and try to get enough information to make smart trades. But by and large, as we increase the holdings of shares of stock to the typical everyday worker, not the everyday investor that does it for a living or looks at the market on a daily basis, hours a day, like we do, and like other people that manage money and take care of people's assets do, are probably going to be setting themselves up for failure if these interest rates don't actually do what they're supposed to do. And that is supposed to stimulate the economy. They're supposed to make borrowing rates go down. But when you drop interest rates a quarter or a half a point, what's that going to do to, even if my car loan offer would go down from 8.9 to 8.5 or even 8 or even 7, I still wouldn't be interested in borrow money at 7%. I mean, it's ridiculous. You want to borrow money at a similar price as what you can save money at. So if the CD rate's around 3.5, I want to borrow money at 3.5 because I can break even on my bank money. It's kind of a wash. But I think going forward, if you're going to bet on making more than 8 or 10% in the stock market, based on how stretched it is, it's just a guess. I mean, it might still happen, but I think the odds are against that from happening. And that was why they were starting to buy bonds, which means the bond prices were starting to go up and the interest rates were starting to fall. And we've seen the trend start shifting that direction. But every time they announce a rate cut, it seems like the opposite happens. So the market's kind of disconnected from what norms have been. And it's probably the most exciting yet the most stressful time to try to trade, follow the market, and make good investments because even the best ones are failing. I mean, I was just looking at a couple this morning, a couple of them that we had. We held one particular one for, I don't know, probably 3 years, and it tripled in value. Well, we got out of it about 2 months ago. And since then, just because it looked like it was rolling over, we knew the institution was selling it. And now it's down 30%. So we got lucky, but we're watching that. There's a lot of people, it'll come back. Well, it's hard to time this market. It's hard to see when really good stocks. And by the way, this is a company, I'm not going to say the company or make it sound like it's a recommendation or whatever, but if you were in our portfolios, you probably know which one of 2 or 3 it was. But the fact is, when you see volume and selling from the inside increase, even if the fundamentals are strong, do you still hold that stock? Well, I guess if you're a 20-year investor, buy and holder, I know in 20 years I'm not going to need my money for that long. That's a different story. But if you're going to be using your money on a regular basis, you need to be actively watching those investments and making sure that you're taking profits when they're there and that you don't just ride the market down when it starts going down. And again, it's individual stocks right now are kind of rearing their ugly head as far as how crazy the stock market can go. Google's on a tear. We had Microsoft get really soft. Oracle's been horrible lately. Micron was flat for like 4 years, and all of a sudden it doubled in price in just a matter of a few months. We've got some just crazy things happening in the market. It stands to reason that a company that has pretty steady growth and steady growth on profits ought to be growing the stock pretty steadily. I guess the reason I'm even getting to that is that probably underscores the importance of managing and watching money and even maybe benefiting by having an advisor that does that. And also the diversification aspect is you can't bet on fundamentals or norms or just logic or even trends affecting your stock or individual positions on a daily basis. So either you close your eyes, stick it in a big ETF or the SPY and just say, well, there's 500 stocks. Let's just ride the market up and down, see what happens. Or if you want to try to do better than the market on some of your money, then you have to be pretty picky. When it comes to what the Fed does, the market tends to react favorably to interest rate decreases. But if you look at the individual stocks that are working within that index, there's really no rhyme or reason as to what's going up any given day other than the hype behind it and other than the fact that somebody's on board to buy it. Market makers are making a killing right now. What I mean by market makers are the big banks that are basically setting the prices. They're setting the buy price at a lower rate than the sell price. Or if you're buying it, you have to pay more than what they'd buy it back from you. And that's called a spread. And typically the spread's pennies. And I've seen spreads dollars lately. And it's interesting that the market's at this point and basing our bets on how crazy the market is right now on an interest rate cut of maybe 0.5% is kind of interesting. And it doesn't make a whole lot of sense to me, but that's what the news is touting. That's what the news is the talking point. That's the thing that is supposed to make or break the market. It won't. What makes or breaks the market is more buyers and sellers. And what makes or breaks the market is more buyers being willing to pay either exorbitant prices per stock or pay $30 for $1 of earnings from a typical company, or out $40. It's even pushing $40 now because earnings are not growing as fast as the price of the stock is. So we're getting more and more overvalued compared to history. And I don't think interest rate cuts are going to solve the problem. It's going to be solved by what happens all the time when the economy gets in a recession like we've been in, when we see stagflation where we still have inflation, but contracting economy, which we really do. If you compare the GDP growth at its snail pace rate compared to even population growth, most of that's attributed to inflation. We still have inflation, but we don't have people, the middle class people, increasing their lifestyle much. In fact, they're getting into more and more debt. We had record Christmas sales over Black Friday and stuff. And I'm thinking, well, gee, we're already tapped out on credit cards. We've got more defaults than ever, more cars being repoed forever. The biggest search engine search is, how do I get out of my mortgage and how do I get out of my car payment? That means there's some problems happening in the economy. It's not as robust as the market would make it seem. And what always happens when they start lowering interest rates is eventually the smart money realizes, which they already have realized in the last year or two, that the market is not as strong as they say it is, and they start divesting their interest. That's why Warren Buffett's more than a third in cash, why Dalio's, I think they've backed off up to 30% or more in some of their top tech holdings. So when you see that happening, you have to be a little bit more cautious about the market. And you have to also believe that just because the Fed says they're lowering interest rates is not necessarily, oh, we're going to stimulate the economy with lower interest rates. It's lowering interest rates because we're in a recession. That's the only way to save us from continuing to get even worse. And eventually, the market's just going to do what the market always does. When the big hedge fund managers, the pensions, the big banks get their big favorite clients out of the market, or at least hedged with a bunch of cash and are ready to swoop in buy low, then they'll just allow the market to crash, and they'll allow the people that have more than $1 trillion in margin accounts, borrowed money in the stock market, when they have to call those margin accounts, meaning they have to force sales of stock. There's going to be more selling than the market can handle because there's not that many willing buyers to continue to purchase stock at the prices that they're at. If so, you'd see all these big money managers like Berkshire Hathaway and the rest that I've talked about buying instead of selling. So that just points to not only a recession, which we've already, if you look at economic indicators, we've already been in for over 2 years. We just aren't really crawling out of it, doing our best. There's a lot of problems that politicians have made based on overtaxing, wasting money, and a number of other monetary policies that don't really work economically. And we're feeling the combined effects of all those as they accumulate and compound. I don't think what happens next week matters. It might make a difference in the market a day or two, but I still expect that we're going to have a retraction in the market. It may be considered a correction. It may be considered a crash. I think these 5% pullbacks like we just had are healthy. All they mean is there's still enough buyers out there to support the market. So it means we don't have to run for the sidelines yet. But when we start seeing volumes either go way down or the selling volume go way up, even if the prices are going up, we know it's manipulation, and we know that that's probably time to go to the sidelines. And I think we're getting close to that point. We've been kind of knocking at that door for quite a while. And I've mentioned that on this show for a long time. The Fed finally decides they have to lower interest rates because the economy really isn't that robust. Then it's kind of a sign to the smart money that things are not as rosy, and maybe they ought to take some cover and divest a little bit. And that's where we have to be, is ready to see what that Fed decrease or non-decrease does to the market, if it's a catalyst to cause this next big sell-off and correction. And if it is a correction, it might be down 20 or 25% like it was in 2022. If it becomes a crash because of how overvalued the market is and how much defaults on credit there are, and I'm not talking just the individual credit card holder, I'm talking there's a big credit crisis, meaning even the banks and the defaults that they've got sitting on their books that they don't have to even declare as losses yet because they have different rules than most companies. And the companies that are seeing more defaults than normal, that's all going to catch up to us, and that's going to cause something. So it may end up being another 50% or like the 2000 crash or like the 2008. But the interesting thing is what Wall Street's going to say is, oh, don't worry, the Fed's lowering interest rates, the economy's going to get better, it always comes back, just ride it out. You can't time the market. Well, if the market's selling off, you can time that. You know that it's selling off and it's not a good place to be, and you can run for cover until it looks healthy again. I can just tell you this, I'm not willing to ride the market down 50% with any of my clients' money or my own. And if we start seeing a sell-off, you need to be careful. And if we start seeing rate decreases, I think it's more of a sign that the Fed realizes things aren't as healthy as they keep claiming on the news. And we have to take that for what it's really worth. There's some measures being taken so that the market doesn't crash, but they can only do that for so long. Pretty soon the rubber band snaps, and we have to be careful of that. And by the way, I'm not saying this to be a doom and gloom. I'm just saying that anybody who retires for 30 years or whatever it is going to see 3 or 4 major crashes. That just is historical. It just is cyclical. They've been printing money and trying to keep us out of the last couple of crashes that should have happened. I don't know how long they'll be able to do that. I had a client come in and says, I'm not worried about the market. They're going to print money to infinity. They finally found out it works. Well, it does work until it doesn't work. We're kind of in an experimental stage. How long can we print money? Japan did it, and they were in a 30-year recession when the market was stagnant for a long, long time. I hope we don't have to go through something that takes that long, but they were in a world of hurt. Most of it was because the population wasn't growing as fast as they needed it to, and everybody got old and retired, and the economy wasn't as robust. I think we're getting kind of that same place. Baby boomers had a lot of kids. The next generation don't want kids, and YZ and everybody else is thinking, why do we want kids? Well, we want kids because it's going to pay your Social Security in the future, and that's what's going to drive the economy so that you can retire. So I think we have to look at all kinds of different forces that are affecting our future. Be careful, be smart, and don't risk money that you can't afford to lose. And also, when the Fed says they're going to lower interest rates, don't just automatically think because the market went up before when they lowered interest rates that it's just automatically going to happen and stay good for whatever time frame.
And I understand that Trump has also picked the successor to Jerome Powell. He's going to announce that very, very shortly. But I think what this means is that this person is going to salute Trump and do whatever he wants. So pretty much I think we can expect more interest rate cuts in the coming year. Talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about current event headlines. Once again, if you would like to come and sit down with Jeff, talk about your individual situation to make sure that your portfolio is aligned for times like these, make that call right now. 520-780-9059. Leave your name, number. Shelley will call you back during the week and set up that conversation for you. No cost and no obligation. Once again, it's 520-780-9059. Jeff, as we enter the holiday season and reflect on the year, a lot of listeners are telling us that they're nervous about the market, they're nervous about taxes, and what surprises that 2026 might bring. So what are you nervous about with the market hitting all-time highs?
Every market correction or crash comes after an all-time high. I mean, if you think about it. So all-time highs just mean that there's more buyers than sellers. What bothers me right now is we're not really seeing increases in buying volume. We're seeing increases in prices. But I think it's because a lot of people are sitting on the sidelines not willing, maybe there's enough people not selling that there still seems to be an upward bias in the market, even though some of these big Mag 7 stocks that have shown reasonably good earnings and some of the biggest companies are still actually earning money because they pretty much got monopoly power and can write their own paycheck to a certain degree. So, I think they'll drive the market for quite a while. But when we look at the top 10 stocks in the S&P 500, that's 500 stocks, but the top 10 make up 40% of all the earnings and profits of the entire S&P 500. We know that there's a lot of weakness in those other 490 stocks. In fact, if those top 10 stocks generate roughly 100% of the increase, then the other 490 stocks on average are break even. So there's 250 or so stocks or more that are probably making all-time lows. The breadth or the consistency across the board, just because the market make all-time highs, but because it's so thinly traded from the standpoint of it's just a few big stocks that are cap weighted, meaning that they get extra credit for being big, which creates more interest in buying their stock, which kind of compounds the issue and drags the index higher, even though it's just a few stocks making it happen. So that's what bothers me, and that has bothered me for quite a while, is the breadth is very difficult. If the breadth was better, I'd be a lot more confident going into the next couple of quarters. Typically during the end of the year, there's some window dressing, what we call window dressing. Most money managers want to end the year on a good note, so they try to buy up some of the biggest positions so they can increase prices of certain stocks that they own and enhance their portfolio value before the end of the year so they can say, look at how much we made, we beat the market, or hey, we came close to the market even though we didn't have as much risk, or whatever their story is. They try to have that little Santa Claus rally. So December is typically a decent month. It doesn't always. Shoot, we had a really bad December back in 18 when there was kind of a banking issue with credit and interest and things like that caused a 25% correction between November and December. And then it finally ended about Christmas. And then we got that last few days of a rally, and it went up from there for decently for the next, year or so until COVID hit. Then it crashed again, and then it came back really fast because they injected trillions of dollars into it to stimulate it. I guess the Fed knows that they can play tricks with this just by printing more money. The problem is the debt service on that's going to kill the economy. It's going to keep us as a nation from growing, making investments, being able to do the things that stimulate the economy from the government side. If all the cash that's going into the government is going to be wasted on stupid programs, and we learned, how stupid some of those programs are with Doge. if it's all going to go to servicing the national debt, there's not a whole lot of investments between infrastructure, between tech investments, even loaning money like they did to help Tesla get started or to bail out Intel and things like that. But those funds are going to be fewer and far between as we go down the road, unless the tariff issue solves that problem. Trump hopes it will, but I think it'll also cause some inflation, which is what's going to increase the idea that stagflation is more prevalent than just a good, robust growth in the economy. I think people's lifestyles are going to be stagnant going forward if the tariffs actually do pass on those increased prices, and if the income from those tariffs aren't enough to keep us ahead of the national debt service. So we can't keep on printing money forever. Some people think that the stock market can stay overvalued forever. Maybe it can. It just hasn't in the past. And I'm kind of a history buff. The most dangerous words in the market, according to John Templeton, who was a very respected investor back in his day, or it's different this time because cycles always repeat and they always come back. It just does it on the market's time, not necessarily our time. So again, I'm worried just about the overvaluation of the market. I think I say that every week. That doesn't mean we're not out there trying to make money by jumping on the trains with momentum. We just want to make sure that we're keeping our eyes forward and then want to jump off the train before it crashes into the wall, before it stops or before something bad happens or it derails. And we want to look for the signs and, again, keep our heads forward, not just be complacent, sitting on this train that's riding forward and feeling great, but we don't know when we're supposed to get off. And if we don't, eventually that train's going to crash like all the other ones have when the market's been as crazily overvalued, overbought as it is right now. And we also see the things that I mentioned before. A big worry is how much margin buying there is and how much manipulation there is with the market makers where they're just setting prices. I mean, if they come in and just decide to drop the price of Meta or Apple 20 or 30 or 40 bucks a share and people get worried and go, oh crap, I need to sell some of my stock in order to pay off my loan because that stock's going down. I don't want to lose all my money. And so they sell more stock and it makes the price go down even more. So market makers seem to be setting the price. It isn't a fair market what somebody will pay for it. It's whatever they put it out there at. So they set the bids, they set the asks. And mostly the bid is what they say is like, hey, we'll buy your stock for this much. And if everybody thinks, oh, the stock's going down, and guess what? The market makers just wait there with their cash and buy low. And so they're the ones that always win. The middle-class investor that borrows money and plays margin ends up always losing when the big crashes happen. And that's what I'm really worried about, is just how exacerbated the crash is going to be for those people that are playing margin, that are leveraging into their gains, but they're always going to leverage, maybe even double or triple their losses when any correction or crash comes. So I think there's just a lot of people that are blind to the risks that they're exposing themselves to. And I think from the standpoint of anybody going it alone and just listen to the news and hearing the talking heads like Kramer and some of those other people on CNBC, and pretty much all of them are talking heads and they have an agenda. So they're touting stocks that they are paid to tout. And honestly, their money's not your money and they don't really care about your money. They just care about making a point and looking important and getting it right enough times to where they get credibility. But eventually you're going to lose money when the market makers make money, because that's how it typically happens. So I shared an article with you, I think earlier this week, Jeff, and we sent it out to our clients also about how the do-it-yourself investor, which kind of reminds me of what I say, the Main Street investor that gets the news and think they can make sophisticated investment decisions, and how they lose more often than people that use an advisor, have less confidence because they go through the roller coaster rides and things like that. Those are the things that worry about. I worry about the defaults. I worry about the credit that we have just in the standpoint that of our printed money. I worry about credit card defaults, the fact that middle class is loading up their debt and they can't afford the debt. I'm worried that the Fed is lowering interest rates because the economy is bad, not because it's really going to stimulate the economy. And I worry about the overvaluation of the market that always tends to retreat to equilibrium sometimes. So there's a lot of things that don't worry me. They worry me mostly for people that aren't our clients, however. They don't worry me for our clients because our clients, if they've followed our plan, have enough money and safety to get them through any of those times. And they're not risking money they can't afford to lose. And we're watching it diligently on pretty much a daily basis, hour to hour even. We're always focused on the road ahead. We're always keeping our eyes out front. We're not looking backwards. We're not resting on our laurels and just saying, oh, we had a good year, let's just let it ride and see what happens next year. We're actively managing these accounts. But when you say what worries me, I'm worried mostly for America in general, but I'm not necessarily worried about our clients' well-being, peace of mind, and confidence in their retirement, to be honest with you.
Jeff, I want to take just a moment here to remind our listeners that if you're looking for someone who can clearly give you the facts as they are, give you access to a wide range of products and services, somebody who can help you preserve your wealth, create an income stream, and also reduce taxes, you might want to call Jeff Hogan here at Premier Retirement. 520-780-9059 is the number. You make that call right now. If you want, leave your name, telephone number. Shelley will be back in touch with you to set up this casual conversation. It's not going to cost you a dime, and there is no obligation. 520-780-9059. You can also find out more about us online at premret.com, PREMRET.com. Jeff, let's take a break. When we come back here on Premier Retirement, we'll answer listener questions and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thanks so much for making this part of your weekend. You're listening to Premier Retirement with Jeff Hogan here on 790 KNST, Tucson's most stimulating talk. And again, we're on the air for you 4 times a week here on KNST. We're on Saturdays at 7, 9, and 1 p.m., and then on Sundays at 11 a.m. And as always, if you missed any part of the program today, we're a podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Hogan. You'll find this show and all of our past shows so you can stay on top of your journey towards a confident retirement. Once again, our telephone number, 520-780-9059. Hear anything that piques your interest today. You want some clarification? You want to have a casual conversation with Jeff? Go ahead and make that call. We'll set you up with an appointment with Jeff, no cost and no obligation. Once again, it's 520-780-9059, and you can make that call this weekend. Just leave your name and telephone number, and Shelley will get right back to you. Okay, Jeff, time for listener questions. Walter's listening to us in Marana. Walter says, "Hi, Jeff. I'm a 52-year-old listener. I'm trying to figure out the best way to get more money into tax-free retirement buckets. I've already maxed out my regular Roth IRA because my income is too high to contribute directly. I've heard about the backdoor Roth IRA and also the mega backdoor Roth through a 401k. What are the limits and which one gives me more tax-free growth? My question is, can you explain the difference between a backdoor Roth and a mega backdoor Roth, including the benefits and limitations of each, and how someone like me would know which strategy makes the most sense?"
Well, actually, at 52 years old, if you're in good health, you might want to consider what I consider a backdoor Roth on steroids, and that is a LERP, and I'll explain that in a minute. But first, to answer your question, yeah, if you make more than a certain amount of money, which isn't much more than 100 grand for a single and 200 for a couple, your ability to contribute to a Roth phases out. So you can put a non-deductible IRA into an account, convert it immediately to a Roth. That's a backdoor Roth, so you can still get the Roth done. And then the mega backdoor Roth is, depending on what your employer would allow you to contribute, you can contribute after-tax money into a Roth 401k, and at your age, you've got all the makeup provisions, so you can contribute over $30,000 into there if you want to, and it could be tax-free growth from there. Now, keep in mind, you do have to pay tax on every bit of that money that you're putting into it. Depending on your income, it may not be as efficient to do the Roth now as it would be to do it later when you're to actually put that extra $30,000 you would be paying in taxes and actually putting it into a tax-free account and maybe doing a Roth conversion later. What some people don't understand is you can't add new money to a Roth depending on your income and the limitations of the 401k, what 401k will cover. But you can convert as much as you want in any given day. So if you've got 2 IRAs or 2 401ks, if you want to convert, depending on the rules of your 401k or IRAs, but if you want to convert from a pre-tax IRA and move it to a Roth, you can do so. You'll just get a 1099 for the move and you'll have to pay taxes on it at this point. If you're making, a couple $100,000 or more a year and you're in the 24 or even a 30% tax bracket because you're making maybe $400,000 or $500,000 a year, you don't probably want to do a Roth at this point. You might want to continue to get that tax deduction for whatever you are putting away if you're in a higher income bracket. And if in 10 years or whenever it is that you decide to retire, it looks like you'll be in maybe a slightly lower tax bracket, you could continue to do Roth conversions at that point, and the overall result may actually look better. You want to pay taxes at the lowest possible rate and potentially, if you can, on the least amount of money. However, if you pay taxes at a lower rate on more money down the road, but it was money that you got to invest early because you saved it in taxes, you may actually end up with more, even though you pay taxes at a lower rate in the future on more money. So again, just because you have more money doesn't mean you'll pay more taxes overall or that the math will prove out to be in your benefit. But that's why we use the retirement roadmap that we use, and we put an income plan down and we see what the math says. We prove everything by math. We see what the numbers say. When should you do this Roth conversion? How much should you put in these things? But I would say if you are in a higher income bracket, either maxing out your 401k or your mega Roth, or even maxing out your distributions into a non-deductible IRA and then doing the conversion through a backdoor Roth IRA, that's great to build tax-free future retirement income. But you might also consider a LIRF. It's actually a life insurance shell, which is different than a Roth or even a 401k Roth, in that every time you take money out of any of those qualified accounts, the IRS gets a 1099. They know about what you're taking out. They may or may not consider it provisional income, depending on what the laws are when you take it out. Right now, it seems like it's not, but there's a lot of rumors that it should be counted and may be counted as provisional income, which would make possibly your IRMA, your Medicare premiums go up. It could possibly make the taxes on your Social Security go up and other things, because there's a 1099 associated and there's, I guess, government reporting involved with any qualified plan, including Roths. I like doing what I would say a Roth on steroids or a stealth Roth. And that is, if you buy an overfund, a life insurance policy, in other words, you just buy the chassis. It's like buying a cash-free money machine. You get to stuff it full of extra cash. You may not make quite as much as you do on a Roth. However, you get to borrow money off of the balance of that account instead of pull it out. So in other words, if a Roth has $1 million in it and you spend $100,000, you only have $900,000. You borrow $100,000 4 or 5 times. Now you only have $500,000 left in your Roth, plus whatever it might have made. On a LIRP, if you have $1 million in a LIRP and you pull out $100,000, you don't actually pull it out, you still have $1 million. You pull out another $500,000 in loans, you still have $1 million plus whatever it gains. So maybe you have $1.2 million, $1.3 million. Might be twice as much as you would have in a Roth, given the similar situation and being able to spend the same amount of money in retirement on a tax-free basis. And the other thing is that account that continues to grow because you're borrowing against it instead of depleting it by withdrawals, ends up the balance of that is available to you for long-term care. It's available to you for terminal illness. It's available to you for big purchases if you decide to just grab a big chunk of it in addition to whatever income you decide you need from it. Or you can just let it grow and be a tax-free distribution to your heirs that can be used for whatever matter. It doesn't have to burden those you leave that money to. So I like Roths and I like LIRPs. I like to use them in tandem, but typically at your age, somebody that's making, let's say, $200,000, living on $100,000 and has $30,000 going into his 401k, but has $60,000 left of unspendable income, some of which will go to taxes. Maybe that extra $50,000 gets put in a LIRP for the next 10 years. You have $500,000 in there. Maybe it grows to $1 million over the next few years. You end up getting to spend that on a tax-free basis, yet that $1 million continues to grow. And the interest on that $1 million, what was originally $500,000, may become $1 million, may become $1.5 million, and continue to grow and increase a death benefit. So where your heirs will probably get back close to what you put in if you use the plan, usually like the way we design them. And you'll find out that you can take a lot more money out of a LIRP. Or by the way, you can do fixed index annuities for income, tax-free income as well, with Roth money as well. Not have to worry about paying taxes on X amount of dollars and have the market crash it. And then you only have so much money in your Roth IRA and you are forced to wait till the market comes back because you don't want to have double paid your taxes on half the money you have. So there's all kinds of ways to skin the cat. Consider those 3 extra tools besides stocks and bonds. 401k is probably all you've done. It's been a great way to accumulate wealth. But for the next 10 years, as you plan for retirement, you might want to consider some of those things that are a little bit safer, more predictable income, some even guaranteed income. And depending on what access you have to your 401k or any prior 401ks that may be accessible, you might be able to start setting up some of those plans in advance rather than wait until you're 59 and a half or 60 when you can start maneuvering your 401k money around and do what you want with it. In other words, probably be a good idea to come look at your options, explore some tools that would be good to know about now rather than when you're in your 60s.
Walter, we appreciate you listening to us in Marana. And again, you can be in touch with Jeff at 520-780-9059. And we certainly do appreciate that question. Okay, Jeff. Next question. Randy's in Vail. Randy says, I'm 41 years old and I've just retired from the service. I have $1.2 million in 4 different accounts, 3 of which are IRAs. I bring in $7,200 a month from my pension and disability benefits. That's the only source of income currently for a family of 5. We have $46,000 in credit card debt, and we're struggling to find a way forward. After all the bills for the month, we have $3,500 a month left for living, food, etc. How do you recommend we get rid of the credit card debt until I can find new employment? Rating my IRA, looking into a SEP plan, or taking out a personal loan? What do you think?
Well, it all depends on how much interest you're paying on that credit card debt. I built my business on credit card debt, and I kept rolling over my balances that were eventually paid off, but I kept rolling them to those introductory rates at 2.9%. So I actually was able to borrow on credit cards and do quite well if you manage that well and you know that you have cash flow that can pay those debts down anytime you need to. But if it's living expense money, you don't want to keep loading up those credit cards if you're paying 25 or 30%. And unfortunately, most credit cards are not giving breaks or introductory rates at 0% for 6 months or 2 years or whatever they used to do. It was kind of a great game to play. And, I know the credit card companies, they just wanted me to use the credit card so that they get their little 1% on the back end from the purchase. Now it's like 3 or 4, plus they want to charge you a boatload of interest, which is probably why Visa and MasterCard are great stocks to own. But they're making tons of money, even though they do have defaults. They're making so much money on everything that they can break your bank if you're supporting them instead of your family. So I get where you're coming from. Paying it down, I don't think maybe pulling out, depending on your disability benefits, you're probably in a low tax bracket, depending on how much of that $7,200 a month is from your pension. Now, you can't really pull out of your IRAs until you're 59 and a half. You can't pull out of unless you do what's called 72T distributions, which are basically life expectancy based distributions, would probably give you maybe, I'm guessing, 3% of whatever your IRA account is. If it's $1 million, maybe you can get $30,000 out per year on 72T distributions. You can't start and stop them like on a month-to-month basis, though. You might want to just commit to do that maybe for a year or two, and then you can cut them off. But there is a formula to get access to some of that IRA money without having a tax penalty on it. And I believe that based on the fact that you're in a very low tax bracket, I'm guessing if you've got kids and a spouse, and let's say half your money's from disability benefits, you're probably paying virtually no taxes. So if, let's say, you had to pay tax on $20,000 or $30,000 a year from your IRAs, you might pay $2,000 or $3,000 in taxes, which is probably less than the $1,000 a month you're paying in interest on that credit card debt. So I would say that would be a good trade. I wouldn't go out and get a loan against your house at 8% just to pay off credit card debt. I don't think. I just hate increasing debt. You just paid one debt for another debt. If you didn't have access to some of that 1.2 million, and of the 1.2 million, I don't know how much of those three accounts make up that 1.2 million that are IRAs. Maybe you only have $100,000 in non-qualified money. I'm guessing if you had non-IRAs that totaled more than 46,000, you'd have probably already paid it off, I'm guessing, right? So I guess you don't have a whole lot of bank money, and most everything is qualified funds that you got through your TSP from the military and so forth. And by the way, thank you for your service. I appreciate all those who risk their lives for the benefit of mine and my family. So thank you, Randy. But I think those are probably the best initial directions I can give you based on what I know now.
Randy, thanks for listening to us in Vail. Good luck to you. And again, if you'd like to have a further conversation with Jeff, call 520-780-9059 and leave your name, number. Shelley will call you back and set up that appointment. No cost, no obligation. And again, we appreciate you listening to us in Vail. Next question, Jeff. Bill's hearing us in Tucson. Bill says, my college-age kids are inheriting $150,000 each, mostly from a 401k, so the money's taxable. I'm still going to be paying for their college, so this money is likely to be saved for the purchase of homes in about 10 years or so. My thought is that they should start withdrawing it from the 401k now while they have little or no income, so the taxes will be low. Where would you invest it? Is there a way with their permission that I can oversee these funds, at least until they're a bit older? So I'm thinking they're about 19. So what do you think, Jeff?
Well, yeah, if they're college-age kids, they're probably legal. Now, how are they getting that 401k money? Is it coming through a trust, and are you the trustee? If so, you can actually withhold it except for college and spend it on your own if the trust is a beneficiary. If they are individual beneficiaries and they are adults, they have the right to take that money however they want to. They have the final say-so, but obviously you as a parent ought to be a good guide, and I hope they trust you enough to where they trust what you're saying. I mean, you could take that out over the next 10 years. You have a 10-year withdrawal period. You could wait till, and I agree with you, it's probably easier to pay taxes at a low or no income level. I mean, you want the deduction to put money into the tuition and books and all that kind of stuff that you can write off and get a 1099 back for a tax deduction while you help your kids go to school. So I get that. Just because they have money doesn't mean they have to use it on their own school, and you save yours and buy them a house with your money. I guess semantics. I guess you could do it that way too. But the bottom line is they want to get that money out of $150,000, all of which is taxable, and pay the least amount of taxes on it. If they wait 10 years, have a good job making $100,000, and then they pull the $150,000 out and add it to their $100,000, they might pay $40,000 or $50,000 total in between state, federal, and other taxes before they actually have $100,000 left for that house. But if they took that $150,000 out, maybe $15,000 a year for the next 10 years, or even maybe $30,000 a year for the next, say, 5 years, and supplemented some of their living expenses, but invested most of it, they could dollar cost average back into the market and potentially have $200,000 or $300,000 after taxes that has mostly been taxed already. And if it's long-term capital gains, when they do pull it out, instead of being at a 20 or 30% tax bracket, which is ordinary income on a 401k distribution, they would have capital gains taxes if they just put it in the stock market and let it ride. So I think with a 10-year forward-looking period, I think pulling that money out little by little, I think you'd be smart to just reinvest it into a personal account. You could be a joint account holder with your kids. You'd both sign off on it and you'd both have access. You could set it up to where either of you have the ability to trade it, or you could set the parameters on it depending on what your kids are willing to sign off on. But you can oversee it. If they were minors, you could do what's called an UGMA, a Uniform Gift to Minors Act, where you actually oversee it. You get to pull the strings and then you just hand it off to them when they get old and responsible enough. But in the meantime, you could either, if it is a trust situation, it's going to have to be distributed over the 10 years to the eventual heirs. You could oversee it as trustee, I suppose, depending on the directions and instruction in the trust, or you could just sign on as basically a joint owner of that account.
Bill, good question. Thanks for listening to us in Tucson. Again, if you would like to have a further conversation with Jeff, call 520-780-9059. You can also find out more about the firm online at premret.com. And if you've got a question you'd like us to answer on the air, you can get it to us by going to Premret using the contact page there. Or if you'd like, you can call it in to Shelley, 520-780-9059. She'll pass it on to us. You're listening to Premier Retirement with Jeff Bogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Once again, if you'd like to sit down with Jeff and be better prepared for your retirement future so you can have a better quality of life, give us a call here and set up your no-cost, no-obligation retirement roadmap, 520-780-9059. It's 520-780-9059. Jeff, let's dive into something a lot of retirees are talking about today, and that's why more people are stepping away from do-it-yourself retirement planning, especially with the 26 tax changes right around the corner. So let's start with the big picture, Jeff. You're seeing more retirees moving away from DIY planning. What do you think is driving that shift?
I think people are fee weenies, to be honest. I think you want me to be just totally direct. That's funny. It's it really doesn't matter what you pay. It's what you get in return for those fees. And there's so many people that I think I think the norm in this business is you could do something at Vanguard or Fidelity and just buy a mutual fund and hold it and probably get the same results as you do by hiring one of their advisors, because all they do is the same thing. And so you think, like, why am I paying a fee? Why would I pay anybody a fee? Well, it's because some people, like independent people like us, do a lot of stuff for those fees. It's not just a matter of, oh, we're going to park your money in the market and you can call me and ask me about the market every once in a while or listen to the radio show and see what I'm thinking. It's a lot more than that. We'll do the annual reviews with you. We'll cover your tax situation. We'll save you probably more in taxes than you'll ever pay in fees. Well, is that worth something? Yeah. And by the way, our portfolios outperform the market indexes too. So if you look at a balanced portfolio with the ones that we manage compared to other managers, shoot, we more than cover our fees. Now, I can't say I can guarantee that we always do that, but so far, so good. I mean, we've had a pretty good track record, and I think we can continue to do that. And by the way, when you pay somebody a fee, you should only do it if you feel like you're getting enough in return for it. There's a lot of things that, this article we sent out, we could, if you want a copy of it, get on our newsletter list, and we'd be happy to send it out. Call Shelley and give her your email, and we'll send you these on a regular basis. But I think most people move away from DIY just because they think it's just going to be expensive and it's going to actually cost them money, because there's a lot of companies that have very low cost ETFs like Vanguard, I'll name them out. And a lot of say, oh, you lose more in fees. I mean, I think Dave Ramsey even says, don't pay fees, just go buy a mutual fund. Well, mutual funds have a lot of fees. And if you read an article in Fortune about 10 years ago, it breaks down all the fees of a mutual fund. Typically, people are paying 3% in fees, but they don't know it because they don't read all 800 pages of the prospectus to find out how many ways they're being charged, including all the trading that they do. I mean, why would a mutual fund that holds stocks long-term have 110% portfolio turnover? Well, okay, are they really trying to day trade and move? Well, maybe they are, but they also make a spread between the bid and the ask price, especially when they're the clearinghouse or the market maker of those stocks that they're buying and selling within. It's kind of like self-dealing. So they're basically creating their own little money machine and churning out profits for themselves and trying to beat the market. And I think that's why most mutual funds don't even beat the market. So then there's this thing called ETFs, exchange traded funds, that have really low fees because they're really just an index of, it just basically buys one of everything in the biotech industry, one of everything in the oil industry, one of everything. And pretty much all ETFs mirror each other from company to company, minus whatever they charge you as a small fee. And typically those fees can be a lot smaller than an advisor. If our fees are 1% or even 1.5%, and that's not atypical for independents that actually manage money. And by the way, we only charge fees on the part that we're actually managing and trading and watching on a daily basis. We're not charging fees on, if you bring us $1 million, we put 2/3 of it into income producing assets or different things that we basically park that generate income or generate tax benefits and things like that. We don't get fees on all of that, even though we manage it all, we service it all, we talk to you about it. You have $1.5 million portfolio, you have $500,000 in each of the buckets. We only charge the fees on the one bucket. So I would almost guarantee that if you're dealing with a typical Wall Street firm, you're going to pay less fees with us, even if the number we show you is slightly higher than what they show you. And the other thing is we had unlimited trading. We don't get charged per trade. And there's a lot of things that we don't nickel and dime in the way that we manage money. So there's a lack of understanding about what you're getting for your fees and if there really is a benefit. And I think that's why people shy away from it. I think a lot of people are also a little nervous because they think that if they deal with an advisor, they're going to look stupid and they don't think they can keep up with the advisor and the complex issues and taxes and things that they're going to talk to them about. But in reality, isn't that what you want? I know that the only reason people would come to me is because they think I'm at least a little smarter than them in something, right? And it has to do with their money and the experience that I have. So people could find out, especially in retirement, that after the 401k, where you can just pick a stock and bond portfolio and let it ride, that once you have to start creating income, when you have to start creating guaranteed income or tax planning, all of a sudden things get more complicated. It's not just talking to your tax man and saying, oh, what do we owe? It's, okay, what do we owe? But how can we owe less next year and the year after and for the next 10 years? And the other thing is, gee, if the market crashes, am I going to lose money? Oh, don't worry, the market always comes back. Well, not if you're spending your money. So most people, when they get retired, they realize, oh, this is more complex than I thought. I have no idea how to manage my taxes. I don't know really how to trade or to look at fundamentals in the stock market. They don't even make sense anymore. And I'm really worried that I'm going to lose money. So those are the three main reasons that people ought to consider the do-it-yourself planning and consider an advisor. There's also data that shows that the average person that uses an advisor makes like 2.3 or 2.4. I've seen a difference. Cerulli and Associates did and also Dalbar, both did studies that said how much more does a typical person that uses an advisor have on average. They do typically about 2.5%, or let's just say more than 2% better than the person that doesn't. So if you pay 1% in fees, but you're still netting 2.5% better, that means you're really doing about 3% better because you're exposed to maybe better funds. Maybe you're moved to the sidelines or hedged when the market looks ugly. You have somebody to bounce ideas off of. But I think the biggest thing that comes with the people that finally breaks the habit of the do-it-yourself, I'm smarter than the market, I can do this because I watch the news and I listen to Kramer every day. And well, they're not looking at your portfolio. They don't know your situation. They haven't talked to you about your goals. They're just talking heads on the TV that give these blanket recommendations that mean nothing to you in the context that your situation is different than everybody else's. So here's what some studies show, that the people that use advisors typically retire 2 years earlier. They typically have twice the retirement savings. Sorry if you're a little late on that, because if you're in your 50s, you probably won't get there in the next 10 years. But that's for people that have started early using an advisor and trying to create wealth and do some tax planning along the way where they can pay less taxes and invest those taxes for actually more money down the road. And here's a big one. They feel far more secure. And on the survey says that 64% of retirees that use advisors feel secure in their retirement, and 29% of the people that do it themselves, even though they feel like doing it themselves, have less confidence, but they just don't want to pay that fee, or they just don't want to be beholden to some company that's making money on their money. Well, you make more than we do. Shoot, you make a lot more than a good advisor makes. The fact is we got to keep the lights on, and we do a lot of stuff. We buy a ton of information that you wouldn't want to afford on your own because we deal with 400 or 500 different clients' portfolios. We want to make sure that we have all the information to make good decisions on investing and making sure that we're in the market at the right time and making sure that we're protecting assets for the right amount of income, that we consider inflation and other things. We also do a 30-year plan where we can show you if you've got a certain amount, $5 million in a retirement account, but you use $1 million of it to buy a cabin in the mountains. And since it's all retirement, you have to pay tax on it. Do you pull out $800,000, pay taxes, and then buy the thing? Or do we actually finance it? Maybe you'd find out that if you financed it or even paid it off over 5 years, you could do better. Or even better yet, maybe we divest over the 10 years before you retire into a LIRP, life insurance retirement plan, put $1 million in there over the next 10 years, and you borrow that $1 million out tax-free, and you paid a lower tax bracket, and you borrow it against your life insurance, and you still have life insurance, and you still have an income fund that grows, and you still have access to money if you go to a nursing home. There's all kinds of different ways to skin a cat, things that you might not even know. And even more stuff, we do tax planning and seminars and some of the events that we do where we basically talk about comprehensive planning in public. We have a slide that shows the 3 basic things that a CPA will tell you. Okay, that's what everybody does. And it's like, okay, invest in a Roth, buy municipal bonds to save taxes, and kick the can down the road and wait as long as you can before you have to pay taxes, because when you're 73, you'll probably be in a lower tax bracket. I mean, that's typically what everybody tells me they hear. So yeah, we do over the years done a lot of seminars and things. I remember one of the slides that's very compelling is our tax saving slide, where we show the 3 things you probably hear from your accountant and the 7 things that you don't. Those 7 things could cut your future 30 years of taxes in half if you do them right. And nobody looks forward like we do. So a comprehensive plan gives you better confidence, saves you real money, and more than covers the fees if you do it right and you deal with a competent planner.
And Jeff, I think that's why nearly 30% of Americans who didn't have an advisor are now looking for one. They're realizing that the goal isn't just to beat the market, but it's to build a retirement that's stable, predictable, and tax efficient. If you'd like to have a conversation with Jeff about our topic today, call 520-780-9059. You can also find out more about us online at primrat.com. Jeff, out of time for this week. I want to thank you for your time, but most importantly, I want to thank our great listeners for joining us. So for Jeff Hogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.